everyone, welcome back to Canada Accounting Insights, where complex Canadian accounting standards become crystal clear. Today, we're talking about accounting for errors under IFRS, IAS 8, and ASPE 1506, a topic that is super important for CPA exams and real-world financial reporting. By the end of this lesson, you'll know how to spot an accounting error, how to correct errors in the current year, how to handle errors from prior periods, when IFRS allows exceptions, and how ASPE rules differ. So grab a notebook, hit that like button to support the channel, and let's dive in. First, we need to understand what an accounting error actually is. An accounting error happens when something is recorded incorrectly, and the correct information was available at the time. That's key. This is not the same as a change in estimate, like updating useful life or bad debt allowances when new info becomes available later. Errors come from things like miscalculations, misinterpreting data, incorrectly applying accounting rules, forgetting to record something, or even fraud. All right, so that's what an error is. Now let's look at the simplest situation first. When we catch mistakes within the current year, when an error is caught before year-end financial statements are issued, we simply fix it right away using a correcting journal entry. This is different from adjusting entries, which are part of the regular accounting cycle. Correcting entries only happen when something was recorded wrong. Think of it like proofreading. If you spot an error before publishing, you correct it instantly. But here's where things start to get interesting. What if we discover the mistake after financial statements have been issued? Let's unpack that next. If an error is found after the financial statements were already released, now we call it a prior period error. Under IFRS IAS 8, the rule is straightforward. Restate prior periods as if the error never happened. This usually involves restating the comparative financial statements, adjusting opening retained earnings for the earliest year presented, adjusting related tax accounts. So instead of fixing the current numbers only, we go back and correct history. To make this real, let's walk through a simplified example you might see in practice or on exams. Imagine a company bought equipment and received a $500,000 government grant, but recorded it as revenue instead of reducing the asset cost. That mistake impacts revenue, depreciation expense, taxes, retained earnings, equipment, and accumulated depreciation accounts. So under IFRS, we restate the prior periods and record adjusting entries to fix the asset, the depreciation, retained earnings, the tax impacts. Okay, that example dealt with a simple error. Now let's look at a situation where fraud causes inventory to be misstated over several years. If inventory is overstated, profit is overstated. In a fraud case spanning multiple years, we may have inflated inventory balances, understated COGS, higher profit reported in each year, excess taxes paid, overstated retained earnings. To fix it, IFRS requires adjusting retained earnings, correcting inventory balances, restating prior financials, reversing overstated tax effects, and if the current year's books haven't been finalized yet, the current period adjustment can be recorded normally. No restatement needed there. Great. Now let's talk about one very important exception that only exists under IFRS. Sometimes it's impossible to determine the impact of an error, like losing records from 10 years ago. In those rare cases, adjust opening balances as far back as possible. Apply corrections prospectively moving forward. ASPE does not provide this flexibility, which we'll talk about shortly. So now we understand how errors are corrected. But what do companies need to disclose when this happens? When correcting prior period errors, IFRS requires transparent disclosure including the nature of the error, the impact on each affected line item, corrections for each prior period presented, if impracticable, why and what was done instead. An additional opening statement of financial position for the earliest year shown. This ensures users understand exactly what changed and why. Okay, now let's compare everything with Canadian private entity standards under ASPE. Both standards align closely, but there are two important differences. So under ASPE, entities must retrospectively restate prior periods. No extra statement of financial position is required. So to wrap this all up, let's summarize our key takeaways. Here's what we covered today. Current period errors. Fix immediately with correcting entry. Prior period errors. Restate prior periods and adjust opening retained earnings. Tax effects. Must be accounted for. Disclosures. Explain nature, amounts, and corrections. Impracticability. IFRS only. ASPE does not allow exceptions. And that's your full breakdown on accounting for errors under IFRS and ASPE. If you're studying for the CPA exam, this topic shows up often, so be sure to practice journal entries and disclosure wording. If this video helped you, please hit like, subscribe, and drop a comment saying, "More IFRS versus ASPE videos." It really motivates me to keep making this content. Thanks for watching Canada Accounting Insights, and I'll see you in the next video.